AI data centers are on track to consume as much electricity by 2030 as the entire country of Japan does today. Data center demand is huge, which is why in today's video, I've got a list of 5 under-the-radar stocks related to this megatrend that have serious upside potential in the coming year. Stay through to the end. The last stock on our list has probably the most underappreciated valuation setups I've seen, and thus makes for a compelling investment right now. By the way, I'm Steve Reitmeister. I spent over a decade as editor-in-chief of Zacks.com, and I'm currently a partner at WallStreetZen.com. If cutting through the noise on AI infrastructure and finding the names backed by real fundamentals is exactly what you've been looking for, then hit that like button right now. Before we dive into the picks, let's take a moment to first look at the big picture behind the AI rally and a weird trend I've noticed. It's obvious the demand is huge, but something strange is going on with the data center stocks getting all the attention. The same ones flooding your feed, the ones with the most Reddit threads. When we analyze those same popular AI stocks through our 115 fundamental factor quant model, they came back with some of the worst scores in our entire database of over 4,600 stocks. For context, we use a simple letter grade system ranking each stock. The lower the grade, the lower the likely the share price performance is going forward. Applied Digital scrapes by with a middle-of-the-road C rating, whereas Nebius is a lowly D. And CoreWeave and IREN are downright Fs, as in the bottom 5% of all stocks we analyze. At the same time, there's a completely different set of data center tickers scoring A or B grades in that same system. Those are the ones we will talk about today because of the greatly increased odds of future share price outperformance. Now, we're talking about 5 stocks that combine real earnings growth, real contracts, and real skin in the game when it comes to the largest infrastructure build-out we've seen since the internet. Now, put together, those 5 stocks can give you real exposure to every critical layer of the AI data center stack. We've got one company that builds the sites and one that powers and cools them. Then a business making the storage that AI workloads run on. Next up is the company making the connectors, linking every component together. And finally, the memory that makes AI processing possible. Okay, let's get on to those stock picks. Let's start with the company responsible for keeping all those GPUs from overheating. I'm talking about Vertiv Holdings with a symbol of VRT. Now, if you subscribe to our free newsletter, then you might recognize this name from our recent strong buy picks. We've featured it several times in the past few months. Pack enough NVIDIA GPUs into a facility, and you have a room generating thousands of watts of heat per rack continuously. The power demands are staggering, and the thermal tolerances are unforgiving. If the cooling fails, the hardware fails. If the power management fails, the hardware fails, right? There's nothing optional about all of this. These are the prerequisites for everything else to function. That's Vertiv's market: power management, cooling infrastructure, and thermal management. Their equipment is in virtually every data center that matters, and as AI facilities scale to densities that have never existed before, the demand for what Vertiv makes scales with it. The company's revenue reached $10.2 billion last year, up nearly 28% year over year, and that translated into a stunning 164% earnings growth. VRT has the benefit of forward-looking visibility. They've got $15 billion in legally binding purchase orders. That's a hefty backlog, and it's grown by 109% from Q4 2024 to Q4 2025. So what does all that tell us? They're durable, real, and growing demand for what they're selling. Plus, the stock was included in the S&P 500 back in March 2026, so it's going to benefit from mandatory index fund buying going forward. Now, the overall grade from our Zen ratings model is a B, but that obscures the fact that it's actually in the top 6% of all stocks analyzed for its fundamental prowess. That shows up a bit more in their A rating for financial strength, where they are in the top 3% of all companies. That is one of the best signs of management effectiveness that usually shows up in more and more earnings beats down the road. On the Wall Street analyst side, here's what stands out. Of the 12 analysts covering Vertiv on our platform, not one has a hold rating, not one has a sell. Every single analyst says buy or strong buy. That level of bullish consensus is generally rare for a stock of this size. Now, let's be honest about risk. At 73 times trailing earnings, this is priced for continued perfect execution. Any pause in AI capital spending will quickly compress that valuation. The bottom line is this: Vertiv owns the power and cooling layer of every AI data center being built. No matter who wins the software race, those facilities had to be powered and cooled. That leadership position doesn't disappear, and that is why Vertiv is such an appealing investment right now. Hey, if you haven't subscribed to our channel yet, then hit that subscribe button now. I publish research like this several times per week, and this is the best way to be alerted when new videos come out. Now we move on to stock number 2 in Sterling Infrastructure with the symbol of STRL. Now, a few years ago, Sterling Infrastructure was a regional civil construction company. Roads, foundations, utility work were their bread and butter. Dependable, but nothing jaw-dropping in the growth category, right? Nothing that would make an AI infrastructure watch list. Then management made a deliberate strategic decision, go all in on the data center site construction. Not the servers and hardwares inside, the actual work from the ground up, like the foundations that a 50 megawatt AI facility sits on, the underground electrical infrastructure, site preparation that has to happen before a single server rack can go in. They branded this the E-Infrastructure Solutions segment, and it now drives the majority of their business. Now, this transformation has shown up in the numbers, and it's hard to ignore. Revenue is up 74% over the past 3 years, helping to power 115% earnings growth. To boot, their backlog has grown by 78% year over year and currently stands at over $3 billion in contracted future work, most of it for hyperscaler clients. Before we get any deeper on this, we have to talk about the valuation. Sterling has rallied by 218% in the past year because of the growth unfolding. This has pushed up their PE to 34.5 times forward earnings. Now, with a valuation that high, it's important that they keep executing a high level to keep shares aloft. Gladly, our fundamental analysis of the firm says that is quite likely. In our proprietary quant model, the Zen ratings, Sterling earns an A overall, which is a firm strong buy. They show particular strength in areas like growth and financials, top 5% and top 3% respectively. Now that's a rare combination, and it tells you the company isn't just growing fast, it's managing that growth with real discipline that generally foreshadows more good times ahead. The risk is customer concentration. Sterling's growth engine is directly tied to hyperscaler construction budgets. If a major client delays a build cycle, revenue visibility narrows quickly, and the investment thesis becomes much less appealing for these shares. Now, plain and simple, if this is the biggest infrastructure build-out since the internet, and it is, then someone has to break the ground. Sterling is going to be that company, and the data fully supports the continued growth story. Now, we are in the middle of our stock lineup with one of my favorite picks in SanDisk Corporation. This was symbol of SNDK. Let me start with the part that deserves to be said up front because I think it makes the rest of this story more credible. SanDisk has run up over 1,100% in the past year. The stock is trading above where most analysts had their price targets set just a few months back. This is not a hidden gem that the market hasn't found yet. That's the honest starting point. But here's why the data still puts it on the list today, and why I recently added to my Zen investor portfolio given its long-term home run potential. It's sitting at the center of a trend the AI infrastructure conversation mostly overlooks, that being the soaring demand for memory storage caused by the AI revolution. Remember that SanDisk was a spinoff from Western Digital back in February 2025, thus unleashing a pure-play storage business. When people discuss AI and memory, they usually mean high bandwidth memory. That's part of the growth story for stock number 5, and it's worth waiting for. But there's a second layer that gets far less attention, that being the NAND flash storage, where the AI training data actually lives. Every large language model requires access to hundreds of terabytes of training data. Every inference workload is constantly pulling from that flash storage. That's SanDisk's market, and their entire 2026 production capacity is already sold out. Let me say that again. Their entire 2026 production capacity is already sold out, and we're recording this in April. Revenue hit $8.9 billion this past year and is forecast to grow another 46% in the year ahead. For as exciting as that is, it pales in comparison to the 120% expected earnings growth for the year ahead. Now, not surprisingly, SanDisk ranks in the top 1% for growth in our quant model. Note that the rating is focused on the consistency of growth, which portends well for more growth ahead. Sentiment is also a strong suit in the top 5%, meaning the smart money is already backing these shares. Now, the risk shouldn't be discounted here. First and foremost is that memory is often a very cyclical business, which often spooks investors at guessing when the peak in the cycle has been reached. Also, they have formidable competitors like Samsung who are ramping up capacity to grab market share. These are all fair counterpoints. Yet the bull case is just too appealing. If they are sold out for the year ahead, and we're talking in April, then demand is truly off the charts, and that won't subside soon. Then on the value front, shares are trading for only 8 times next year's earnings per share forecast. This makes it one of the most compelling growth and value stories around, and why I recently added to my Zen investor portfolio. Our next pick has a very different profile, a quiet pullback in a business that's actually accelerating. We are talking about TE Connectivity, the symbol of TEL. Now, the market has been rough the past few months, but TEL has been roughed up more than any of the 5 stocks today, and thus maybe the most mispriced right now. TE Connectivity flexed some muscle in the latest quarterly report, where their digital data networks segment reported AI-related revenue growth of 70% year over year. They also posted record orders of over $5 billion, showing there is a lot of demand visibility to more growth ahead. The business accelerated while the stock declined. That kind of gap is exactly the type of opportunity our Zen rating system is designed to uncover. So what do? They have been making the physical connectors, sensors, and cables that go inside critical technology systems for over 80 years. Transportation, defense, industrial automation, and increasingly AI server racks. The high-speed copper and fiber connections linking components inside a hyperscale data center, the connectors designed to handle constant heat cycling at GPU-level power densities, those are TE Connectivity products. Let's say that one again. The high-speed copper and fiber connections linking components inside a hyperscale data center, the connectors designed to handle constant heat cycling at GPU-level power densities, those are TE Connectivity products. Every major hyperscaler expanding right now is buying them, which explains why earnings per share is forecast to grow nearly 60% in the next year. It's currently trading at just 18 times forward earnings, well below the average for a business with this kind of earnings growth trajectory. This also shows up in their attractive PEG ratio of 1.09. In our system, TEL earns an A overall, placing in the top 5% of all stocks for its fundamental prowess. Even more surprising is the A grade for safety, the strongest safety score on the list today. It's also got solid B grades, putting the top 20% for value, growth, sentiment, financials, and even our proprietary artificial intelligence rating. The risk is that a portion of TE Connectivity's business is tied to the automotive and industrial cycles, which can soften. And the momentum grade is only a C in our system because of the recent weak performance. The bottom line is a 16% pullback in a business growing earnings at nearly 60% a year is a great setup. Here's the bottom line on TE Connectivity. The recent pullback in shares helps create a great entry point for the tremendous growth story trading at a very attractive valuation. This points to ample upside potential ahead. And if you want to see more high upside stocks, then claim your free copy of our special report, 3 Stocks to Double This Year. The name of the report kind of says it all, so get those 3 tickers now by going to the link in the description below or scan the QR code. Now it's time for the 5th and final pick you've been waiting for, and that is Micron Technology with a symbol of MU. Here's the exciting setup. Micron is the #1 ranked stock in the entire semiconductor universe. That's because it's not just A-rated overall, but it's also crushing it with A grades for value, growth, financial strength, and sentiment. This is a clean slate of excellence, foreshadowing more share price outperformance ahead. This is precisely why Micron is one of the top 20 stocks in my Zen investor portfolio. Now, to see all 20 stocks in my Zen investor portfolio, then click the link in the description or scan the QR code. I'm not the only one who likes it. Wall Street analyst coverage is about as closely unanimous as you can get. Right now, 25 analysts are issuing ratings for the stock. 17 of them have strong buy, 7 of them have buy, and only 1 has a hold. The reason why Micron has been able to pull off those growth numbers is pretty straightforward. Every AI data center runs on Micron's high bandwidth memory, the HBM chips that sit directly alongside the GPU and feed it data at maximum speed. Without HBM, the processing power of an NVIDIA GPU cannot be fully utilized. And guess what? Micron's 2026 HBM supply is completely sold out. And recently in NVIDIA's GTC conference, Micron announced it has entered volume production of HBM4 for NVIDIA's Vera Rubin platform, extending the demand story well into 2027. Now, here's the part that stops most people in their tracks when they look at the stock. The forward PE ratio is under 4. This is not a utility stock. This is a dynamic technology company riding the AI wave, leading to 411% earnings growth year over year. You can get in on some of Micron's incredible growth right now at a discount to what the broader market charges for the most boring companies. A disconnect of this magnitude is great. The only problem is it doesn't last for long, so please investigate it soon to see if it has a place in your portfolio. Okay, let's bring it back to the big picture. The data center boom is real, but where you invest in it matters enormously. Every name on the top half of the table tells you everything you need to know about which side of the divide you want to be on. These 5 companies together form the complete picture of how an AI data center gets built and run. Sterling breaks the ground, Vertiv powers and cools it, SanDisk stores the training data, TE Connectivity supplies every physical connection holding the servers together, and Micron makes the AI computation itself possible. You don't need to predict which model wins or which cloud provider takes the most market share. You can simply own the infrastructure that every single one of them depends on. So here's my question to you. Which of these 5 stocks are you adding to your watch list now? Drop me a note in the comments section below. And if you want to see 5 more stocks that have a massive upside in the next 90 days, then check out the video that's popping up on your screen right now.